So I'm going to talk about the scintillating topic of business entities. I know that at times it can get a little dry. So what I'm going to try to do is go over some basics and leave quite a bit of time for questions, because I've found that a lot of times, y'all know what you want to hear, and you know what you want to get out of this. So I'm not going to try and force it down your throat. Just let me know when we get to that point what you want to talk about. So business entities are a very important part of any business, whether you're out there by yourself, playing a guitar and singing, or whether you're a part of a band, or whether you're going to be starting some type of recording group, or recording studio rather. So the big question and number one item that you need to think about is liability. And unfortunately, these days, we're in a very litigious society, and a lot of times when there's some type of an accident, you're going to get sued. And I like to start sometimes by talking about what happens when you just decide to start a business with a couple of friends. So let's say there's three of you. You go out. Maybe you're a band. Maybe you have a recording studio. And you just hold yourself out as a business. You start, performing your services. You get money for those services. And at some point, you hire somebody who is working for you, and that person, runs somebody over with a car while they're working for you, or they knock over a speaker onto somebody. And the fact that the three of you have held yourself out as a business entity, means that you have created what's called a general partnership. And I'll talk about that in a second. But the upshot is that you will be personally liable. Every one of the three of you will be personally liable for the full amount of damages that comes out of that accident. So you might not even know that you've created a business entity, and you might not know that you're going to be liable for someone else's actions. So that's why it's really important to understand how to create business entities. So the personal liability is the main thing. Tax treatment is important. I'll talk about that briefly, and duration of the entity. So in my example before, there were three people that started the business. Well, if it's just one of you, you're what's called a sole proprietorship. So all you have to do is hold yourself out as a business, hold yourself out as performing services, and you're a sole proprietor. If an employee hurts somebody, causes damage, you are personally liable. And they can come after you for not just the assets you use in the business, but your car, your house, or any other personal assets you have. So that's really, again, the crux of the business entity issue. Like I said before, when you have two or more members, two or more people starting a business, you have a general partnership. And the general partnership, like I said before, has unlimited liability. So the three of you are all on the hook for the entire amount of any damages that occur. There is something called a limited partnership. The way that works is you have to file a particular form with the Secretary of State, and most of the partners can have limited liability, but in a limited partnership, you need at least one general partner, and that general partner has to be liable for everything. So I know you all have been told time and time again to form an LLC. I'll talk about that in a second, but that's the difference, is that for a limited partnership, you've got one person that's going to be liable. One nice thing about a partnership, or at least being a partnership for tax purposes, is that there is no double level of tax. So when the entity earns a profit, that profit flows through to each individual partner's tax return, and you only pay tax on it once. Now, that is in contrast to a corporation. And I'm sure y'all all know public companies, they're all corporations. And the key benefit of a corporation is that every single shareholder has limited liability. So when the shareholder pays money for a share, what that means is that if there's something that happens at the corporate level and the corporation gets sued, the worst that can happen to the shareholder is to lose that investment. But there's virtually no way for a claimant to go after that shareholder personally. What you give up with a corporation is the single level of tax. So with a corporation, you've got a tax at the corporate level, and then when you distribute that money up to the individuals, you have a second tax, which is the dividend tax. So for many years, a lot of people had to decide between using the corporate form, paying 2 levels of tax but having limited liability, or using the partnership form, having unlimited liability but being able to pay only 1 level of tax. So the limited liability company was created. And this entity has now become, I think, one of the main business entities that's used by both small and large businesses alike. The LLC combines sort of the best aspects of a corporation and a partnership. So you've got limited liability for all members like a corporation. But you can use the LLC to be taxed, or rather you can elect for the LLC to be taxed as a partnership. And what that means is that you get that single level of tax along with the limitation of liability for everybody. Now, when you go out and form an LLC, which I'll tell you about in a few slides how to do that, you form the LLC. If there's one of you, it's taxed as a sole proprietorship, okay? And that's the default rule. If there's 2 or more of you, then it is taxed as a partnership as the default rule. For tax purposes, you can elect to be what's called an S corporation. And I mention this because I've gotten a few questions over the years about whether someone should elect to be an S corp. An S corp is sort of it's a hybrid. It's like a partnership in that there is a single level of tax, and there is limited liability for all owners. So it's similar to a partnership in that respect. But there are limitations on the number and the type of members or shareholders, and there's also limitations on how you share profits. Generally, a partnership is more advantageous because you have more flexibility. Some practitioners like S corps because they feel that there's more law and there's a lot less uncertainty surrounding it. But in my experience, the partnership is really the form that you want to take, rather, the LLC taxed as a partnership is really the form that you want to take when you have multiple members. So how do you form an LLC? Well, first, what you need to do is you need to go to the Secretary of State's website. And you check to see whether the name that you want is available. One thing to know is that you can have, each state has a LLC statute. And when you organize an LLC, you're doing it under the laws of a particular state. So most people that are, unless you're a large corporate or a large business that wants to incorporate or form in Delaware, which is pretty common, most small businesses form in the state in which the partners or the members are residents. So for a lot of you, you may not be from here. And you may want to form your LLC in your home state. But I wanted you to know that at the end of the day, it doesn't really matter. A lot of the statutes are pretty similar. You can form an LLC here in Louisiana and do business anywhere. I'm going to talk about Louisiana LLCs, but this is, the general concepts are not limited to Louisiana. So what you do is, like I said, you go on the Secretary of State's website, you check to see that your name is available. and then you need to file what's called the Articles of Organization. And these are pretty simple. It's a pretty simple form. You can do it online now, and it just asks you a couple of questions, and then you get your registration right there online. There's a $100 fee, and one thing to note is each year you have to file an annual report to stay in good standing. So what that means is you have to say if there is a change in any of the owners or the managers. And actually, that reminds me, I need to put this on the slide. There's two ways that you can organize an LLC. It can either be member managed or it can be manager managed. Typically, depending on how the relationships between the owners work, a lot of times you'll have one manager. And so let's take a band, for example. A lot of times there's one person that kind of is the driving force behind it, maybe is the business-minded person. They're the one that sets everything up. So sometimes people will organize the LLC as a manager-managed LLC and list one person as the manager. And that means that one person can sign contracts and do everything else on behalf of the LLC. If you don't designate as manager-managed, you are member-managed. And if you're member-managed, that means that any individual owner can sign a contract on behalf of the LLC. So if you don't want that, you have to make sure that you provide in your Articles of Organization that, first off, that you're manager managed, and then that the members don't have the authority to sign on behalf of the LLC. It's only the manager. So what I was talking about with the annual report is that each year, if there's a change in the name and address of the manager, you have to tell them in this annual report. If there's no change, you just say no change. But you need to do that on an annual basis. And if you don't do it, eventually they could revoke your charter. So this last point is about an operating agreement. Now, an operating agreement is a document that's prepared. You really need an attorney to prepare it, because what it does is it outlines the business relationship between the owners. And a lot of times I've run into this a lot where in the beginning you've got 3 or 4 people, you're all on the same page, you're all going to make a lot of money, real excited, you're not really that concerned about anything in terms of business relationship. But then, a year later, something happens and somebody gets upset. Somebody, thinks that they can make more money doing this somewhere else. And there are a lot of issues that can come up at that point. Who owns the property, or who's going to get the property that was purchased with company funds? Who owns the copyright if somebody's written music, if it's a band? Who has the royalties? Who gets the royalties ongoing? How are the assets split, but also, if it's an ongoing business and only one person leaves, how does that work? Do you have to pay them cash to leave? Can they just take property that they contributed with them? All of these issues you don't think about starting off, but can become a real problem later on. So if there are, 2 or more of you that are starting a business together, I would highly recommend going to an attorney and talking to them about an operating agreement. They do have forms online, but I would caution you, because a lot of times these services, what they do is they'll take provisions from different agreements that have different reasons behind them, and then they'll kind of stick them together. And they don't always cover all the circumstances, and there can be little gaps there. I know that in the beginning when you're starting out, it's a pretty big expense to incur to talk to a lawyer. But I've been talking to John about trying to get some forms together and make some attorneys available to help out the starting entrepreneurs and the starting musicians. So we'll see where that goes. But it's really important to think about these things ahead of time, because when you're in a dispute later on, you're not going to agree. And if you can agree up front, it will save you a lot of headaches later on. Okay, so like I said before, there are two types generally of businesses, or rather two tax structures that you will use. If you form the LLC by yourself, you are a sole proprietor, and what that means is that the income that you earn through the business will flow through to your personal tax return. There is a Schedule C to your Form 1040, which is what you're supposed to file every year. And in that form, you can outline all of your expenses and your income, and then it just flows through onto your personal return. This is something that you can probably do on your own. If you can afford an accountant, it's good, because an accountant can help you find business deductions. For example, if you own a home and you do use a portion of it exclusively for business, you can deduct some of your expenses, some of your home expenses and your other expenses involved with that home office. But there are limitations on that, and it can get a little complicated. So if you talk to an accountant, a lot of times they can help you save money in the long run. Now, if there's two or more of you, like I said before, you're going to be a partnership for tax purposes. And a partnership has to file a separate partnership tax return. Now, it can get a little confusing, because the partnership has to prepare a return as if the partnership pays tax. So the partnership is going to have a list of all of its income and expenses, kind of like a corporate tax return. But once the partnership determines what the taxable income is for the year, that income then flows through to the partners, to the members. And what that means is that each member will receive what's called a K-1 form. And that K-1 will say, your share of income for this year is $5,000, $10,000, whatever it is. And that amount then needs to be reported on your personal return. So one thing to keep in mind, with a partnership, with the LLC taxed as a partnership, you are going to pay tax whether or not you receive a cash distribution. So how it works is that if the partnership earns $100,000 in a year, and there are two of you, and you keep that $100,000 in the bank and you don't pay it out in cash, that means that each of you is going to have a tax liability based on your $50,000 share, even though you didn't receive any cash. Now, this is probably not going to be an issue when you start out, because you're probably going to be distributing all of your cash. But it is different than a corporation in that sense, that you get taxed on the income of the partnership regardless of whether you get any cash distributions. So the IRS website has those forms. Like I said, with the Form 1065 for the partnership, it gets pretty complex. I really highly recommend getting an accountant if you are being taxed as a partnership, because it is very difficult to fill it out and it's very easy to make mistakes. All right, so let's talk about some of the tax issues. Let's talk about some of the tax issues in addition to the income tax issues, which is what I'd been talking about before. You have other tax issues that you have to consider. Now, sales tax is a big one. If you're a band and you're out there and your main source of income is the money that you receive from the club from your guarantee, then that's going to be income. It'll be reported on your personal tax returns for federal tax purposes. If you sell merchandise and you're getting the money, there is a separate tax regime, the sales tax regime, that is administered by the states and the cities. And you need to pay sales tax on those sales to each state where you are selling the property. So if you go on tour and you go through 5 different states, you need to pay, you need to register and you need to pay sales tax. Now, a lot of people don't do that, but I've seen cases where if a band gets big enough and they've done enough tours, they've done enough business in a state, somehow a local government gets wind of this and they can go back and really, run you through the ringer. So it's important to make sure that you register in all the different states where you're going to be selling merchandise. Now, in Louisiana, you have to register with the Louisiana Department of Revenue. And if you go on their website, you can file an online application. You get a revenue account number. You'll need that revenue account number for both the sales tax and also to file a state income tax return. So you'll be filing both the federal tax return and the state tax return. The self-employment tax is basically something that is going to show up on your return, on your, if you're a sole proprietor, you're going to have it in that Schedule C. But I bring it up because I want you all to understand how it works. If you are an employee and your employer, withholds, so you don't get a check for the full amount of your wages, you get something less. And the employer is withholding 2 things. One is for income tax. So the employer is withholding federal and state income tax. But the employer is also withholding what we call FICA, which is Social Security and Medicare. And normally the employer pays half and the employee pays half. So you're paying about 7.5%. When you are self-employed, you are responsible for the full 15%. So if you do fill out your own tax return, it's very important that you make sure that you're accounting for that self-employment tax at 15% at the end of the day, and you're going to have to pay that on all the earnings from your business. Now, one thing to also remember about the filing of the tax returns, the taxes when you are an employee, like I said, are withheld. So every single paycheck, the employer is required to withhold, and the employer then is required to pay that money over to the government so that at the end of the year, you already have a certain amount that's been paid in, and either you owe a little bit more or you get a refund. When you are self-employed, you are responsible for paying your own taxes to the government. Okay, nobody's withholding. In general, you need to pay quarterly, what they call quarterly estimated taxes. And that is basically an estimate based on your prior year's tax experience. You're supposed to pay a quarter of that each quarter so that by the end of the year you've paid, you've kind of duplicated what would have happened if you had withholding from an employer. If you don't do this, even if you pay your tax liability on time, you file your return, you figure out that you owe, $2,000, you pay the government $2,000, they are actually going to hit you with a penalty because they're going to say that you should have paid in the past year 4 quarterly tax payments each quarter. So that's another thing that is, when you start, making some money and that becomes an issue, talking to an accountant will help you figure out, what amounts you really should pay at that point. I left a bunch of time here for questions. I can talk about other issues if you want. I can answer specific questions. It's really up to y'all. So, does anyone have any questions? Yeah, right there. Mm-hmm.
That's 120 forms a year you have to fill out. You might have only sold a few CDs.
Yep.
Is there any way, and that's a lot of work,
Mm-hmm.
120 forms a year just for selling CDs. But that's, and for 50, if it was 50 states, it would be 500 of them. So is there any way around that? Like, is there any way you could, like, be selling something other than physical product, and then the CD is in return for that? Like, can you set it up in a way where somebody is like joining your fan club for $10, and they just happen to get a CD as part of the fan club? Are there ways around that instead of having to fill out 600 forms a year?
Yeah, I mean, so, most states, the way that they'll let you, you file a sales tax return, and then, if you don't have income in that state, say maybe you go there once a year, you do a tour and you're going to be going through the state once a year. They'll usually let you file, quarterly or possibly even annually, depending on the state. If you can show that, look, I come here once a year, I sell $100, $200, $500, whatever it is, and then they'll let you do it on a, you don't have to do it every month, because most of those months will be zero. So that's, the short answer to that. In terms of, packaging it differently, I mean, sales tax is typically, like you said, on sort of tangible property. So CD, shirts, whatever. If they're paying to join your fan club, that could still be taxable, because even though it's generally for tangible property, a lot of times there are some service aspects that are taxable. In Louisiana, I don't know if that would be taxable, but there are a lot, I don't think it would, but there are a lot of states where it would. So I don't know if that's really going to get you around, the problem.
Seems like a lot of paperwork.
It's a lot of paperwork. Being in business is a lot of paperwork, and there's not a whole lot you can do about that. Yeah.
I think the practical question is when do you have to worry about being audited?
Well, you can be audited anytime. Now, the way that it works typically is that you file your taxes and you put down income and deductions, and the IRS takes those numbers and they put it into a computer. And that computer has some complex algorithm that nobody knows how it works, except for like 2 people in the IRS. And that algorithm takes all the data from everyone and looks at your data, compares it to their data, and certain things will pop up red flags. So that is, one of the ways where you get audited. So if you're doing something that is unusual, then that increases your risk for the audit. You can also get audited just by they pick some people at random. So that's another way that they'll pick you. Now, obviously, there's probably a dollar level, that they might not pick you if you're not making a whole lot of money. But I can tell you, I've had people come in that had, very little income, and they've been audited. And the IRS, they just choose somebody at random. So it doesn't mean that, you're not going to get audited just because you're just starting out, or you're not making a lot of money. Now, the states, on the other hand, they're, who knows what they do. I mean, they don't really have a particular, well, some do, but a lot of them don't have a particular way of choosing audits. They just kind of do it randomly. So, yeah.
Most venues take a percentage out of shirt sales.
Mm-hmm.
Would that be enough to say that they are selling merch and thus it'd be under their sales tax?
No, because really what's going on there is, you're paying them sort of a kind of a rental fee almost, and really the way that should be handled, if you paid them more than $600 in a year, you should give them a 1099. And just in case anyone doesn't know about that, when you if you're an employee, you receive a W-2 at the end of the year, which is where the employer says, that they paid you X dollars and withheld Y dollars. Well, if you're not an employee, but you're an independent contractor, which is, for example, if your band has a manager who manages 10 other bands, that manager is going to be an independent contractor. So if you have independent contractors that you pay more than $600, you need to send them a 1099. And that's how you report payments from your business to those types of people. So, it would be that kind of payment, depending on how much it was, that you might have to file a 1099 for. Yeah.
So if you are getting audited by the IRS, how often will they, if you own a business, will they look at both the business and also look at your entire employment? Will they typically just do this, or will they look at the entire employment?
Well, if they're auditing your business, they'll typically focus on the business books and records. If they have a reason, though, to think that you're doing some funny business, then they absolutely can look at your history. But that's not typically a part of if there's 5 owners to a business and they're auditing the business, they're not necessarily going, to each owner and looking at every other aspect of their taxes. But if they find something, then they might take that next step. Okay. Anyone else?
Do digital sales count as tangible objects?
That is being fought very vociferously in a lot of the state legislatures right now. There is a huge, states are very slow to, update their laws for new technology. And, I know Louisiana is claiming that it is subject to sales tax. There are a lot of practitioners who are resisting that, and there have been some lawsuits filed. So that is still sort of shaking out in the courts. And, but, it's a thorny issue right now. There's really no clear answer.
This is a question more about business formation and taxes. A lot of our students are musicians. They're going to be professional musicians. And they don't necessarily just play in one band. They might, play in their own, have their own band.
Mm-hmm.
Or they're just a side person in multiple bands.
Sure.
At that point, would it be in someone's interest to form a business as for themselves? My business is me.
Yes.
And then at what point is your, your food, so your groceries, that's helping your business, but it's not really your, you know what I'm saying? Because as a business, if you don't eat, your business isn't going to go anywhere. So how do you separate your business expenses from your personal expenses if your business is you?
Well, you can think of a single member LLC, which is what you're talking about basically. You're the one owner. It's actually not different than a 2-member LLC in the sense that, there are things that are deductible as a business expense, like if you have an office, a phone line for your office, if you're traveling, certain travel expenses. And there are things that are not deductible, like mostly food, unless there's certain circumstances where you can deduct that when you're on the road. But so regardless of whether you're single member or multiple member LLC, you're still going to have the same limitations on what you deduct. So what I recommend is first off and actually you have to do this if you want to try to keep your limited liability, create your own bank account for the LLC. Even if it's just you and you've got your own personal checking account, open up a separate checking account for the business, have all of the receipts for the businesses that come in, the income, that goes into the business checking account, you pay expenses out of that business checking account. If you need money personally, you write a check from the business account to your account, and then you write the check from your personal account. So, that's kind of mechanically how you do it, but you're still going to have to figure out just on a general, tax deductible question, regardless of how it's organized. Thank you. Yeah.
Yeah, so say you're at a band and you buy some equipment for yourself and the band's not going to pay for it.
Mm-hmm.
You deduct that kind of thing from your personal expenses, or would you have to form your own LLC?
Well, again, you can conduct a business without an LLC. So you report it for tax purposes exactly the same way. It's on that Schedule C I was talking about. So I guess in theory, you could, try and you can take business deductions as a sole proprietor. If you start holding yourself out, though, as a business, and, then you run the risk, though, of the liability issue. So if you're going to do that, and what I would recommend is, especially if you're going to be playing in different bands, and just set up an LLC, have that be your business account, and then if you go out and you play for somebody and they cut you a check, just have that go right into the business account. And then there are definitely expenses that you can deduct because of that, of running a business. So something like that might be something that you can deduct. There was someone up there. Maybe not. Okay. Nobody else? Was that crystal clear? Huh? Well, I guess I think what I might do is just talk for a few more minutes about the mechanical aspects, because I think, from a practical standpoint, that is really important to do. So remember, the whole point of an LLC, of forming the LLC, is to limit your personal liability. And you do that by keeping your business and your personal separate. So, like I said before, when you form the LLC, the first thing you do is form the LLC, you get a tax ID number from the federal government, and then you go open a bank account. You have your business bank account. What you want to do is take all of your, all the income that you receive, that goes in the business bank account. You write checks. If the business needs money, you write a check from your personal account to the business account, and then you can do vice versa when you need personal money. If you don't do this, what can happen is there is a doctrine called piercing the corporate veil. And what that means is, if you are basically using, you say that you have opened or formed an LLC and you're conducting business in this LLC. But if you are actually, commingling funds and, paying personal expenses, out of this business account and not really keeping things separate, and somebody were to sue you and the business, that person could make the argument that you had commingled funds, you had kept everything so tightly combined that you never really conducted business in that LLC form. What really happened was you're a sole proprietor, okay? Or if you were a group, you were just a general partnership. You just kind of commingled everything, and the court is not going to respect the entity as a separate entity from you. They're just going to look straight through it to you. So keeping those, the business and the personal separate is important for that reason. And that's the primary reason. But a secondary reason when you have multiple members is it's also a way to make sure that everyone knows that everything's happening on the up and up. Because I've heard stories about bands where they're trying to save up for a sound system. Somebody keeps some cash that they hold back each gig, and that cash is sitting in someone's house. And, you can run into problems with that because, again, I've seen it happen where people wind up having issues with each other, and then the question is, well, where's the record of that cash? Do you trust that person? That person might, who knows what they might do with that money. So, it's really helpful to think of this as a separate entity for every single purpose. And it will help prevent you from getting into trouble, both with the government, in taxes, but also among yourselves. And it's unfortunate, I see it happen a lot, but if you are able to keep that sort of that wall up between business and personal, it helps really in every aspect. So I think that's all I've got. If we don't have any more questions, I guess we can end a couple minutes early. Okay? Thank you very much.